When you picture the cutting edge of the future, when you think about artificial intelligence or massive data centers, cloud computing, all that endless expansion of digital infrastructure, what is the image that immediately pops into your head?
I mean, you probably picture sleek silicon chips, right?
Yeah, exactly. You picture glowing server racks humming in some sterile, highly secured, air-conditioned room somewhere.
Right, or brilliant software engineers typing away in Silicon Valley.
Exactly. Building the virtual, the intangible, the cloud.
Yeah.
But you know what you almost certainly do not picture? Mud.
Yeah, and that oversight is it's one of the most fascinating blind spots in modern technology today.
It really is.
We have been completely conditioned to just, visualize the end product. We visualize that frictionless digital experience.
Right, the instant query response from an AI or seamless streaming video.
Exactly.
Yeah.
And we completely ignore the physical, heavy, and honestly often chaotic reality required to make that frictionless experience possible.
Yeah, the paradox of our digital future is that it doesn't actually start with software. It starts with millions and millions of tons of dirt.
Oh, absolutely.
It requires pouring asphalt, crushing rock, laying heavy underground pipe, pouring just thousands of yards of concrete, and, actively fighting off severe weather systems while you do it.
You simply cannot have the cloud without the mud.
You really can't. And to explore this stark juxtaposition, we're looking at a very specific, incredibly detailed source today. We've got our hands on the Q2 2026 earnings call transcript for Granite Construction.
Ticker symbol GVA for those tracking it.
Right, GVA. And this call took place on July 30th, 2026. Now, for anyone listening who might not follow the heavy civil construction sector on a daily basis, Granite is one of the largest infrastructure contractors and construction materials producers in the entire United States.
Yeah, they build the roads, the bridges, the literal physical arteries of the country.
Exactly. But as we unpack this transcript today, we're going to see how they are also building the physical bedrock of the AI revolution.
Which is what makes this document so much more than just a quarterly financial update. I mean, we're using this transcript as a lens, really, to get a boots-on-the-ground view of the entire American infrastructure landscape.
Yeah. The mission for this deep dive is to decode how a legacy, heavy civil engineering firm is capitalizing on the AI boom.
And how they're strategically navigating this massive, constantly evolving labyrinth of federal government funding.
Right. And perhaps most surprisingly, the absolutely ingenious financial gymnastics they're executing in the background to protect their shareholders from dilution.
Yeah, that part is wild.
It really is. So I promise you that by the time we finish this deep dive, Wall Street jargon that might sound completely alien right now, terms like CAP, hyperscalers, progressive design build, and the ever-intimidating convertible notes, they will not only make perfect sense, but you will understand the underlying mechanics of how they actually function in the real world.
You'll be able to explain the macroeconomic strategy of a heavy civil contractor at your next dinner party.
Right. I mean, the term hyperscaler alone is a fantastic dinner party conversational pivot.
Oh, it sounds incredibly futuristic until you realize it requires a literal fleet of bulldozers.
Right, exactly. So let's just jump right into the numbers because the headline financials in this transcript are explosive. I was reading through the revenue figures, and for a company that moves physical earth, the growth rate is just staggering.
It really is.
For the second quarter of 2026, Granite hit $1.5 billion in revenue. That represents a 29% increase year over year.
Yeah, a massive jump.
But the metric that really forces you to stop and reread the page is their operating cash flow. Year to date, their operating cash flows zoomed to $142 million.
Right.
And during the exact same period the prior year, it was a mere $5 million.
Which is just an insane trajectory.
I mean, scaling cash flow from $5 million to $142 million in a 12-month window in a low-margin, high-overhead industry, that requires an operational masterclass.
It does. And the structural reason for that leap requires us to break down the two main engines that are actually driving that $1.5 billion in revenue.
Okay, let's break them down.
So the first engine is their construction segment. That accounted for about $1.2 billion of the total.
Wow, okay.
And what management pointed out on the call, which is really crucial for understanding the health of the business, is the actual composition of that growth.
Right. Where is it coming from?
Exactly. So $172 million of that came from pure organic growth.
Meaning their existing operations winning more bids, right?
Yep. executing more efficiently, simply doing more work with what they already have. But another $98 million came from acquired businesses.
Ah, okay.
They've been strategically buying up smaller players to expand their footprint, and those acquisitions are immediately yielding revenue.
Yeah, and I noticed that exact same dynamic in their second engine as well, the material segment.
Right.
This is the division that actually owns the quarries. You know, they produce the crushed rock, the aggregates, the liquid asphalt. That segment brought in $248 million.
Which is substantial.
Yeah. And again, acquisitions played a massive role there, contributing $60 million to that total, which was heavily driven by a recently acquired company they mentioned called Warren Paving.
Right. The Warren Paving deal was huge for them. And when you blend the construction side and the materials side together, their adjusted EBITDA, which, for anyone listening, that basically strips out one-time accounting anomalies to show core operational profitability.
Right, the real cash engine.
Exactly. That reached $186 million. That is a $34 million increase from the previous year.
Wow.
Yeah, they are making money on the construction contracts, and they are making money selling the physical materials to themselves to fulfill those contracts. It is a closed-loop ecosystem.
It creates a really powerful vertical integration, doesn't it?
Absolutely. Because when you control the materials, you control your own supply chain. And in today's inflationary environment, that is just a massive competitive advantage.
Yeah, you aren't waiting on a third-party supplier to decide to hike prices on you. And that actually leads perfectly into the first major piece of industry mechanics we need to unpack here, which is CAP.
Ah, yes, CAP.
The transcript mentions that Granite CAP had a record $7.4 billion. That is a sequential increase of $250 million just from the first quarter alone.
Which is a huge jump, quarter over quarter.
It is. And to translate this out of corporate speak, CAP stands for Committed and Awarded Projects. I kind of look at CAP like the reservation book at a highly exclusive, world-renowned restaurant.
Okay, I like that analogy.
Right. It doesn't tell you how much money is sitting in the cash register at this exact moment. It tells you exactly how busy your kitchen is going to be for the next 2 years.
Yeah, that's a great way to put it.
If your reservation book is completely full for 24 months, you sleep pretty well at night knowing the demand is locked in. A $7.4 billion CAP means Granite's metaphorical restaurant is booked solid for the foreseeable future.
Yeah, and the visibility that provides a management team, it really cannot be overstated. It allows for incredibly precise resource allocation.
Right, you aren't guessing.
Exactly. You know exactly where to send your heavy machinery, where to hire labor, and where to scale your material production.
But let me challenge the safety of that number for a second.
Okay, go for it.
Because an enormous backlog can actually become a lethal liability.
Well, absolutely.
We live in a world of stubborn inflation, supply chain hiccups, and severe labor shortages. If I book a catering gig today for a wedding 2 years from now, and I lock in the price, but the cost of chicken and labor triples in the meantime, I lose money on that wedding.
You'd go bankrupt trying to fulfill your own backlog.
Exactly. So how does Granite look at a $7.4 billion promise and ensure those massive future revenue numbers actually materialize into profit?
Well, that is the existential threat for any heavy civil contractor.
Yeah.
A massive CMPP is really only as valuable as the risk mitigation built into the underlying contracts.
Right.
And Granite's management clearly believes they've engineered those contracts to withstand macroeconomic shocks. You can see that confidence loudly broadcasted in their guidance upgrades.
Yeah, CFO Staci Woolsey didn't just report a good quarter, she actively raised their future guidance.
Which you don't do lightly.
Right. They bumped their full year 2026 revenue guidance to a range of $5.3 billion to $5.5 billion. They are essentially daring the market to doubt their backlog.
Yeah, they really are.
And they didn't just stop at this year. They looked out to 2027 and completely rewrote their expectations. Their original projection for 2027 organic revenue growth was sitting at a modest 6% to 8%. Now they are projecting it to be above 10%.
That's a massive revision upward.
It is. And they also bumped their annual operating cash flow target up to 11% of revenue. You just do not make those kinds of upward revisions, projecting years into the future, unless your contracts contain highly aggressive escalation clauses or you have structurally de-risked the way you bid on projects entirely.
Yeah. And they have absolutely altered their bidding structure, which we'll dissect when we look at their government work in a bit.
Yeah.
But before we get to how they protect the contracts, we have to look at what is actually inside that $7.4 billion reservation book.
Right, the mix of the projects.
Exactly, because this was really the defining moment of the earnings call.
You're talking about the pivot to the digital realm.
Yes.
Yeah, we expect a heavy civil construction company to be paving highways, fixing bridges, expanding airports. And obviously, they are doing all of that. But the absolute shock to the system in this transcript is Granite's explosion into data center site development.
It's fascinating.
CEO Kyle Larkin spent a significant portion of his time detailing this. A year ago, their data center CAT was $65 million. In this second quarter of 2026, it jumped to $223 million.
That is exponential hypergrowth in a single 12-month period.
Yeah, and this introduces our next vital concept. Hyperscalers.
Right. So a hyperscaler is a large-scale cloud service provider operating at just a massive global level. Think of your Amazon Web Services, Google Cloud, Microsoft Azure, Meta.
The giants.
The giants. And the sheer computing power required to train large language models, to run generative AI, and to host global digital infrastructure. It requires server farms of a magnitude that is honestly difficult to comprehend.
Right. But the disconnect for a lot of people is why these elite tech giants need a dirt-moving company like Granite.
Yeah.
I mean, if Google is building a data center, shouldn't they hire a specialized, high-tech architectural firm?
Well, the high-tech installation happens at the very end of the process. Before a single server rack can even be delivered, the physical reality of the site must be conquered.
Conquering the mud.
Exactly. You cannot just drop a massive state-of-the-art server farm onto a random field. These hyperscalers require hundreds of acres of intense civil site development.
What does that actually look like on the ground?
We are talking about massive amounts of land clearing and grading. We're talking about deep, complex trenching to lay high-voltage power conduits and redundant fiber optic networks.
Right.
We're talking about pouring enormous, heavily reinforced concrete foundations engineered to hold immense, concentrated weight without settling a single millimeter.
Because if a server rack tilts, that's a disaster.
Exactly. Yeah. And perhaps most importantly, installing advanced, high-capacity water infrastructure for the liquid cooling systems these servers desperately need so they don't literally melt down.
Wow. So it is the ultimate physical prerequisite to the cloud. You have to conquer the earth before you can reach the sky.
That's exactly it.
And what is brilliant here is that Granite didn't just stumble backward into this tech money. They saw the wave forming.
Oh, they were very intentional about it.
Yeah. The transcript notes that earlier this year, they officially launched a dedicated data center division. They carved out some specialized leadership to coordinate these incredibly complex civil infrastructure needs for hyperscalers across Granite's entire geographic footprint.
Right.
Larkin stated on the call that their goal is for this specific data center sector to represent 10% or more of their total annual revenue in the near term.
Which is a deliberate, highly resourced targeting of the fastest growing capital expenditure market in the world right now. I mean, tech companies are spending billions on infrastructure, and Granite is positioning themselves right at the front gate with a fleet of excavators.
I have to push back on the safety of this strategy, though.
Okay, let's hear it.
It sounds fantastic on paper to chase tech money. I mean, every company on Earth wants a piece of the AI pie. But at its core, Granite's bread and butter for the last century has been state departments of transportation, highway projects, municipal water systems.
Public works.
Yeah, isn't there a massive operational risk in pivoting away from your historic core competency just to chase an AI hype cycle? Like, what does a highway company really know about the specialized needs of tech giants?
The fair question, but the transcript actually provides a direct counter to that fear, and it hinges on the definition of a pivot.
Okay.
Because Granite's strategy here isn't to pivot in terms of capability. They aren't learning a new trade or buying entirely different equipment. The CEO pointed out that they have actually been doing this exact type of data center site work for over a decade.
Really? A decade?
Yeah. Primarily in places like the Pacific Northwest and Nevada, where server farms have historically clustered anyway. So they already have a long proven track record with these specific hyperscaler clients.
Oh, okay. So they aren't the new kids on the block desperately trying to learn the lingo. They've been in the trenches literally with these companies for years.
Exactly. And from an operational risk standpoint, Larkin emphasized that they are leveraging their, quote, geographically diverse home markets.
What does that mean in practice?
It means they're using the exact same local crews, the exact same fleets of bulldozers and pavers, and the exact same project management expertise that they use to build a highway interchange. But they are deploying them to prepare a data center site instead.
I see.
It's the exact same physical work, moving earth, pouring concrete, laying pipe. The core competency hasn't changed at all. They're merely applying their existing industrial muscle to a faster-growing, higher-margin client base.
Okay, that makes perfect sense. To use an analogy, it's like a highly skilled commercial baker who usually spends all day making standard wedding cakes, suddenly realizing there is a massive, incredibly lucrative market for ultra high-end corporate cupcakes.
Right.
The baker doesn't have to go out and buy new ovens. They don't have to learn a new trade. They use the same flour, the same industrial mixers, the same pastry chefs. They're just piping the exact same ingredients into a different shape for a client who is willing to pay a premium.
That is a perfect analogy. They aren't trying to become a butcher. They're just optimizing their bakery.
Exactly.
And because of that, the risk profile remains entirely stable because the physical execution remains identical to their daily operations.
Okay, so they have this incredible high-growth private tech vector, but we cannot ignore their traditional bedrock. As exciting as data centers are, publicly funded transportation infrastructure is still the massive engine driving this company.
Oh, absolutely. It's the core.
And when you are dealing with state and federal highway projects, you are entirely at the mercy of the government checkbook. The political winds basically dictate your backlog.
Yeah, and the current state of that government checkbook is a really fascinating study in legislative timelines. Because the bedrock of current federal funding is the IIJA, the Infrastructure Investment and Jobs Act.
Right. That was the massive $1 trillion federal funding bill passed a few years ago that has been pumping capital into state DOTs.
Exactly.
So what did the earnings call actually reveal about the timeline of that money? Because these bills do eventually expire.
They do, and the transcript gave a very clear, highly analytical update on this. CEO Kyle Larkin noted that about 60% of the funds from the IIJA have been spent or allocated so far.
Okay, 60%.
Now, the act itself is technically set to expire in September of 2026.
Wow, that's coming up fast.
Right, and if you just read the headline, that sounds alarming to an investor. A major funding source is drying up next year.
Panic sell?
Exactly. However, because of the slow, methodical way federal infrastructure spending actually works, moving from federal authorization to state allocation to environmental review to actual project bidding, the remaining 40% of those funds will continue to be deployed very slowly.
Okay, so it doesn't just vanish at midnight in September 2026.
No, not at all. Management estimates this remaining capital will actually support active construction projects through 2028, 2029, and likely all the way into 2030.
Okay, so the money faucet isn't suddenly turning off. It's a long, sustained tail of capital.
Exactly.
But Wall Street doesn't just look at the long tail of old bills, right? They are obsessed with what is coming next. If the IIJA officially expires in 2026, what replaces it?
Right.
And this brings us to another piece of legislation that Granite's management is watching like a hawk, the Build America 250 Act, commonly referred to as BA 250.
BA 250, right.
This is the successor legislation currently drafted and moving through the U.S. House of Representatives.
And the way a construction company views draft legislation tells you everything you need to know about their internal risk tolerance.
How so?
Well, a change in government funding priorities, like shifting money from highways to rail or from maintenance to new builds, can drastically alter a contractor's fortunes.
Right. They have to adapt to wherever the money is flowing.
Exactly.
And according to the transcript, Granite's management views the BA 250 draft incredibly positively. But their reasoning is entirely counterintuitive to how most people think about megacorporations.
It really is.
I mean, you would assume a massive civil contractor would want the government to fund gigantic, multi-billion-dollar mega projects, the biggest, flashiest suspension bridges, entirely new interstate systems, massive high-speed rail corridors.
The stuff that gets him in the news.
Right. But Larkin specifically pointed out that they favor BA 250 precisely because it shifts the funding mix away from large discretionary mega projects. Instead, the bill focuses heavily on, quote, formula-based programs and bridge investments. I have to stop here, because why on earth would a multi-billion-dollar construction company prefer smaller, boring bridge repairs over a $10 billion mega project?
It comes down to predictability, localized monopolies, and risk management.
Okay, explain that.
Discretionary mess projects are inherently dangerous for a contractor. They are highly political, which means they can be canceled or delayed by a change in administration.
Oh, true.
They require incredibly complex environmental reviews, massive right-of-way land acquisitions, and they are notorious for catastrophic cost overruns.
A classic 10-year delay.
Right. If you win a single $3 billion mega project, your entire company's quarter-to-quarter financial health is tied to the whims of that one job site. Formula-based programs are the exact opposite.
So formula-based programs, they just distribute money to states based on standard boring metrics, right? Like state population, total highway miles, fuel tax formulas.
Correct. The federal government cuts a check to the State Department of Transportation, and the state uses that money for steady, predictable maintenance.
Like repaving a 20-mile stretch of existing highway.
Exactly. Or replacing a standard overpass. Upgrading drainage systems.
Let me frame this with an analogy because the strategy here is really brilliant. Imagine you run a highly successful residential construction company. Chasing a discretionary mega project is like getting hired to build a massive, one-of-a-kind $50 million custom skyscraper for an eccentric billionaire.
Okay. Yeah.
The potential payout is huge, sure, but every single detail is a custom headache. The city fights you on permits, the architect changes the design constantly, the foundation requires experimental engineering, and if one subcontractor strikes, the entire project stalls and you bleed money daily.
It's a massive risk.
Right. Formula-based funding, on the other hand, is like getting hired to build 50 standard, high-quality suburban homes in a new development. You already have the blueprints. Your crews know exactly how to pour the foundations in their sleep. You know precisely how much lumber and drywall it takes.
It's basically an assembly line.
Exactly. The suburban homes are predictable, they are repeatable, and you can execute them efficiently to guarantee a 15% profit margin on every single one. Granite strongly prefers building the 50 suburban homes. They want the steady stream of predictable bridge repairs across their diverse geographic footprint, rather than betting the entire company's balance sheet on one custom skyscraper.
Yeah, the risk profile of a mega project is simply too asymmetric. And this strategic preference for smaller, predictable projects ties directly back to your earlier question about how Granite protects that massive $7.4 billion CKP from inflation.
Right, the risk mitigation built into the contracts.
Exactly, because they aren't just changing what they build, they have fundamentally changed how they contract this work with the government.
Yeah.
The transcript heavily highlights their transition toward something called progressive design build.
I was hoping we would get to this because progressive design build sounds like standard corporate jargon, but the mechanics of it actually represent a revolution in how public infrastructure is built in this country.
It really does.
Let's start with how things used to be done, like the traditional design bid build model.
Okay, so in the traditional model, which has dominated public works for a century, the government owner, say a state DOT, designs a highway project entirely on its own, using internal engineers or third-party consultants.
Okay, so they draw up the blueprints in a vacuum.
Exactly. And once the design is finished, they put the blueprints out for public bid. Contractors like Granite look at the blueprints and bid a price to build it. But here's the catch. By law, the government usually has to accept the lowest responsible bid.
So it creates an immediate race to the bottom. Contractors bid aggressively low just to win the work.
Yes.
But how do they make a profit if they bid rock bottom prices?
Through change orders and litigation.
Oh, wow.
Yeah. As soon as the contractor starts digging, they inevitably find that the government's design was flawed or the soil conditions are different than promised. The contractor then halts work and demands more money, a change order.
So it is an inherently adversarial relationship from day one.
Absolutely. The government and the contractor end up fighting in court over who absorbs the cost overruns. It is a recipe for delays, blown budgets, and ruined margins.
So how does progressive design build fix that toxic dynamic?
Progressive Design Build, or PDB, completely flips the script. It is a collaborative delivery method.
Okay.
The contractor is brought in by the project owner at the very beginning during the initial design phase before the blueprints are even finished.
Wow, okay.
Granite's engineers sit at the same table as the state's engineers. They work together to design the project, actively identifying potential physical risks, engaging in value engineering to save money, and collectively figuring out the true realistic costs of materials and labor.
So it is about alignment and balanced risk sharing before a single shovel hits the dirt.
Precisely.
So Granite is essentially consulting on the blueprints to make sure the project is actually buildable without the contractor losing their shirt. They can point out, hey, if you route the highway this way, we have to drill through solid granite, which will cost an extra $50 million. Let's move it 100 yards to the left.
Exactly. It's practical problem solving.
And the transcript noted two other massive risk mitigation tactics they use in conjunction with this collaborative approach. First, CEO Kyle Larkin stated they universally try to price their work only when the design is at 100%.
Yeah, and this is a vital defense mechanism because in the past, contractors might be forced to give a guaranteed price when the design was only, say, 30% complete, absorbing massive blind risk.
Right, guessing what the other 70% is going to cost.
Right. By waiting for 100% design completion before agreeing on a final price, Granite can take those finished blueprints and instantly lock in firm quotes from their own subcontractors and raw material suppliers.
They completely eliminate the guesswork.
Yes.
And the second tactic Larkin noted is that they actively limit their pricing exposure on contracts to less than 4 years. If a government project is so massive that it will take 7 years to build, Granite won't lock in a fixed price for the whole thing.
Because it is macroeconomically impossible to accurately predict the cost of diesel fuel, liquid asphalt, or union labor 7 years into the future.
Right. Who knows what oil will cost in 2033?
Exactly. By capping the contract duration at 4 years or less and pricing only at 100% design, they ruthlessly insulate themselves from commodity and labor volatility. They are systematically de-risking their backlog.
They are essentially building a financial and legal fortress around that $7.4 billion reservation book. They are demanding collaborative designs, short timelines, and absolute cost clarity.
Yep.
But, and this is a massive but, despite the soaring revenue, despite the AI data center boom, and despite the bulletproof contracts, we have to remember the fundamental reality of this industry.
The dirt.
The dirt. Heavy civil construction is a physical business. It operates outside in the physical world, and the physical world does not care about your financial fortress. If it rains, you stop working.
You do.
Which brings us to some of the incredibly tough realities discussed in the materials segment of this earnings call.
Yeah, the physical reality of moving earth is unforgiving. And we see that clearly reflected in the margin compression during this quarter. It was not all record-breaking sunshine.
Quite literally not sunshine. Let's look at a metric that immediately jumps off the page as a red flag.
Okay.
CFO Staci Woolsey revealed an 800 basis point decrease in gross profit margin and a 310 basis point decrease in cash gross profit margin, specifically in the materials segment.
Ouch.
Yeah, and for anyone who doesn't speak in basis points, an 800 basis point drop is an 8% drop in gross profit margin. In a business that already operates on tight margins, an 8% contraction in your materials division is a massive squeeze on profitability.
It's huge.
What were the culprits dragging this down?
Well, the transcript points to two main physical realities, and they perfectly illustrate the vulnerability of the sector. The first culprit was Mother Nature.
Okay.
The CEO stated that severe weather systems completely disrupted production and sales activity across their southeast region during the second half of the quarter.
Right.
Think about the logistics of producing and laying asphalt, or moving millions of tons of aggregate rock. If you have torrential rain and severe storm systems sitting stationary over the southeast for 3 weeks, your quarries flood and have to be pumped out.
Wow. Yeah.
Your heavy-haul trucks cannot run safely on muddy, saturated haul roads. And from a pure chemical engineering standpoint, you absolutely cannot lay 300-degree hot liquid asphalt onto a waterlogged highway base.
Right. It won't bind. The project just halts. You literally have to tell your crews to go home, park the machinery, and wait for the sun to come out.
And that waiting is incredibly expensive. That severe weather resulted in an approximately $10 million drag on the materials segment results for the quarter.
Just from waiting around.
Not from waiting.
No.
Because you were still paying overhead, your $1 million equipment is sitting idle depreciating. You were still paying salaried managers, but you were producing zero revenue. It is a pure, unmitigated loss of efficiency.
Okay, so that is the first culprit, the $10 million act of God. What was the second factor driving down the margins?
The second factor was a $5 million hit due to higher production costs associated with what management vaguely referred to as quarry development activities, specifically plant setup and redevelopment.
Yeah, this one requires some translation.
For sure.
When a construction company talks about quarry development, what they actually mean is they are re-engineering the physical layout of where they extract rock.
Right.
They are stripping away useless topsoil, which is called overburden, to get to new veins of good rock. They are dismantling massive rock-crushing plants and physically relocating them closer to the active mining face to reduce haul times. They are upgrading their conveyor belt systems.
Yeah, it's a massive undertaking.
To me, these quarry development costs sound exactly like renovating the kitchen in your primary residence.
Oh, that is an incredibly apt comparison for capital expenditures.
Right. While the kitchen renovation is happening, it is a nightmare. It is expensive, it is loud, there is dust everywhere. You can't cook your own meals, so you are spending more money on takeout, and your day-to-day life is totally disrupted. It feels like a massive financial and emotional grind.
Right, you're just bleeding money.
That is the $5 million hit to their margins. But you don't renovate your kitchen to lose money.
Like that.
You do it because once it is finished, the house is fundamentally worth more. You have better appliances, you can cook faster, the workflow is more efficient. Granite is spending $5 million right now to upgrade their quarries, put in better automation, and expand their reserves. It is a short-term pain on the income statement for a long-term gain in production efficiency.
And management was very careful to frame it exactly that way to the analysts. The CEO clarified that this $5 million drag was a first half of the year environmental issue. It is a deliberate capital improvement project, not a systemic failure in their operational cost controls. And this brings us to the silver lining. Because if you look beneath those margin drops, the underlying metrics of the materials segment are actually incredibly robust.
I noticed that too. The volume of material they need wasn't the problem at all. In fact, their internal asphalt sales, meaning the asphalt that Granite's materials division produces and then sells to Granite's construction division for their own projects, skyrocketed by 73%.
Yeah, that is a $42 million increase in internal sales.
They are essentially their own best customer, fueling their own construction projects and capturing the margin at both ends.
Furthermore, they demonstrated strong pricing power in the open market. The transcript noted that aggregate pricing achieved their targeted mid-single-digit percentage increases through the second quarter.
Okay, so they raised prices and the market absorbed it. Demand remains incredibly strong. But what about that $10 million weather delay in the Southeast? If you couldn't pave a road in June because it was raining, is that revenue just gone forever? Does the state just say, never mind, keep the potholes?
No, and that is a crucial dynamic for understanding the construction cycle. Management explicitly expects that the tons of material that were delayed by the rain will simply shift to the right on the calendar.
Oh, okay.
The economic demand didn't vanish, the highway contract is still signed, the roads still need to be built, the work just gets pushed to the third or fourth quarter. This allows Granite to remain fully on track to meet their annual 2026 guidance goals despite a tough quarter.
The other massive physical risk we have to address here is energy. To run a heavy civil construction company, you need an absolute ocean of energy.
Oh, yeah.
You need millions of gallons of diesel fuel to run the excavators and dump trucks. And oil prices, as we all know, are highly volatile, swinging wildly based on global geopolitics. If oil spikes, Granite's costs should theoretically skyrocket and wipe out their margins. But the transcript says the impact of energy inflation on their segment performance was, quote, minimal.
Yeah.
How is that physically possible?
Well, it's through a highly sophisticated, multi-layered risk mitigation strategy. When the analysts pressed management on this during the Q&A session, the CEO explained that they utilize a combination of financial and physical hedges.
Okay, what does that mean?
On the financial side, they use fixed forward contracts, essentially locking in a set price for diesel fuel months in advance.
Smart.
They also have energy surcharges embedded directly into their government contracts dating back to 2021, meaning if oil goes above a certain price, the state DOT automatically covers the difference.
Wow, okay. But my absolute favorite detail from the call, which shows how gritty this industry really is their reliance on physical storage.
Yes, it is the ultimate hedge against financial markets.
They literally maintain massive, specialized tank farms to physically store liquid asphalt. When the global price of crude oil drops in the winter and liquid asphalt is cheap, they buy it in massive bulk quantities and pump it into their own storage tanks. They just hoard it.
They just sit on it.
Right. Then during the peak summer paving season, when demand is high and prices spike, they just draw from their own cheap reserves. They physically isolate themselves from the daily volatility of the commodities market.
It's brilliant.
It is the industrial equivalent of buying a giant chest freezer for your garage and stocking up on 100-pound sides of beef when it goes on sale at the butcher, so you simply do not care if the price of steak doubles at the grocery store next month. It is so beautifully, brutally pragmatic.
It perfectly bridges the gap between commodity trading and physical reality.
Well, moving from the very physical act of storing thousands of gallons of liquid asphalt, I want to shift our focus to moving money. Because if you can't control the weather and you are constantly battling physical entropy, you have no choice but to build an absolute fortress out of your balance sheet. And a massive portion of this earnings call was dedicated to the capital structure of the company and M&A mergers and acquisitions.
Yeah, this is where we see the transition from engineering physical infrastructure to engineering corporate finance. And the maneuver Granite pulled off in this quarter is complex, but it is an absolute masterclass in protecting shareholder value.
Let's break this down step by step, because this is where the Wall Street jargon gets incredibly dense, but the underlying narrative is fascinating.
Okay, let's do it.
The CFO, Staci Woolsey, announced that Granite issued $600 million in senior unsecured notes. In plain English, they went out to the debt markets and borrowed $600 million in brand new debt.
Right.
Why did they do that?
They raised that $600 million to fund the settlement of their older 3.75% convertible notes.
Okay, convertible notes. We promised at the beginning we would explain this for the dinner party. What exactly is a convertible note? Why were they so popular a few years ago? And why are they suddenly a ticking time bomb for Granite?
To understand the convertible note, you have to look at the macroeconomic history of the last decade, specifically the ZIRP era zero interest rate policy.
Right, when money was basically free.
Exactly. A convertible note is a hybrid type of corporate debt. A company issues these notes to borrow money from investors. The investors get regular, usually low, interest payments, in Granite's case, 3.75%.
Okay, so a standard yield.
But the note has a special convertible feature. At a certain future date, if the company's stock price has gone up past a predetermined strike price, the investor has the right to convert that debt into actual shares of the company's stock.
Oh, I see. It's a sweetener. The investor accepts a lower interest rate on the bond because they get a lottery ticket attached to the company's stock price.
Exactly. Companies loved issuing them during the zero interest rate era because it was incredibly cheap capital. You could borrow hundreds of millions of dollars for next to nothing. But the danger lies in success.
Right. Granite issued these 3.75% convertible notes years ago. And since then, Granite's stock price has soared. They are highly successful, which is a great thing for the company generally, but it triggers a catastrophic problem with these specific notes, right?
Yeah. Because the stock price went up so much, the investors holding those notes are absolutely going to exercise their right to convert them into stock.
And if that happens, Granite would be legally forced to instantly issue or print millions of brand new shares of stock out of thin air to hand over to those investors to settle the debt.
And that is a nightmare scenario for the everyday retail shareholder listening to this because of dilution.
Right. If I own 10% of a pizza and suddenly the restaurant owner decides to slice that exact same pizza into a million extra pieces to feed a crowd of new people, my specific slice just got microscopically small.
Just shrinks.
My ownership stake is diluted, and my shares become significantly less valuable. The fundamental value of the company hasn't changed, but there are way more pieces of the pie. So knowing this dilution event was looming, how did Granite's management stop it?
They executed a brilliant defensive financial maneuver. They took that new $600 million in traditional debt they just borrowed, and they approached the convertible note holders.
Okay.
And they essentially said, we see that your notes are in the money, but instead of giving you millions of newly printed shares of our stock, we are going to exercise a clause to settle this obligation by just paying you your profits in cold, hard cash.
Wow. CFO Woolsey stated they expect to use roughly $570 million of that newly raised cash to settle the majority of these conversion obligations.
Yep.
And what is the net result of using cash instead of stock to settle the debt?
Well, by using cash, Granite effectively intercepted and prevented the dilution of approximately 2 million shares of their stock. They retired the dangerous convertible debt, replaced it with standard debt, and entirely protected the existing shareholders' piece of the pizza.
It is an incredible defense mechanism. But this brings up a huge glaring question I had when I was reading the transcript.
Oh, the accounting chart.
Yes, because right after the CFO explained how great this maneuver was for shareholders, she mentioned they had to take a massive, ugly accounting hit to pull it off. She stated they recorded a $363 million non-operating charge in the quarter, and they still have an additional $270 million debt discount to recognize as interest expense in the next quarter.
It sounds terrifying on paper.
We are talking about over $600 million in financial charges hitting their income statement. If I am a casual investor scanning an earnings report and I see a $363 million charge, I panic. I assume the company is bleeding cash. How can taking hundreds of millions in financial charges be considered a strategic win for the company?
This is where you must separate the accounting reality from the cash reality. It is a critical distinction that trips up a lot of people reading financial statements.
Okay, clarify that for us.
Those massive numbers, the $363 million charge and the $270 million discount, are largely non-cash accounting charges.
Non-cash, meaning that they didn't actually write a check for $363 million to a bank.
Exactly. They did not lose $363 million in physical cash. What happened is a product of complex derivative accounting rules.
Okay.
Because Granite's stock price went up so drastically over the years, the theoretical intrinsic value of that conversion option attached to the debt also skyrocketed. When Granite finally settled the debt, the rules of corporate accounting required them to record what is called a loss on remeasurement of the conversion option derivative.
That is a mouthful.
It is.
Right.
But simply put, the accountants have to look at the current high value of the stock, compare it to the old strike price, and record that difference as a massive loss on paper to balance the books when they close out the instrument. It is a mark-to-market accounting adjustment.
So it hits the net income line, making the quarter look terrible on a GAAP basis, but it does not mean $363 million vanished from Granite's operating bank accounts.
Exactly.
Okay, so if the accounting looks horrendous on paper, what does the real-world operational impact look like?
The real-world impact is overwhelmingly positive and positions them for future dominance. By refinancing this complex debt into standard senior notes, Granite cleaned up their capital structure so effectively that they secured inaugural investment-grade credit ratings from both Moody's and S&P.
That is a massive stamp of approval from the institutional financial world.
It is. It lowers their future cost of borrowing.
Right.
They cleared out a toxic, dilutive debt overhang. They ended up with a vastly stronger, cleaner balance sheet, enhanced financial flexibility, and as we established, they preserve the equity value for their investors.
So it was a conscious decision to take short-term, non-cash accounting pain to secure long-term structural health.
Absolutely.
That makes total sense when you break it down. It is exactly like taking a massive one-time penalty fee to break a terrible adjustable rate mortgage on your house so you can refinance into a much better, stable 30-year fixed rate that secures your financial future.
That's exactly what it is.
The penalty fee looks horrific on this month's bank statement, and you wince when you pay it. But you know mathematically it was the smartest thing you could possibly do for your long-term net worth.
Precisely. And having that clean, strong, highly rated balance sheet is exactly the weapon Granite needs to execute on the final major theme of this transcript, their aggressive M&A muscle.
Right. Because they are not just growing organically by winning bids, they are actively buying market share. The transcript highlighted that they recently acquired a company called Kenny Seng Construction.
Yep.
And we saw earlier in the breakdown that this single acquisition immediately added $150 million to their CP backlog.
Yep.
That is a massive, instantaneous injection of guaranteed future revenue, and they're aggressively hunting for more. The CEO estimated they have another $200 million to $400 million lined up for M&A spending just for the rest of 2026.
What stood out to me in this section wasn't just the raw amount of capital they are deploying, but the specific methodology of how they are finding these target companies. Yeah. When an analyst pressed management on the health of their acquisition pipeline, Larkin noted a very specific statistic. 75% of their M&A pipeline is self-sourced by their internal corporate development team.
Why is that distinction so important? Does it really matter who finds the deal as long as the numbers make sense?
It matters immensely to the ultimate success and profitability of the acquisition. In the corporate world, a massive percentage of acquisitions are driven by investment banks.
Okay.
A bank will package up a mid-sized construction company, create a slick presentation, take it on a roadshow, and essentially shop it around to the highest bidder in an auction format.
Oh, I see.
Those bagel deals tend to be very expensive because they are highly competitive. You pay a premium to win the auction, you pay massive fees to the bankers, and frankly, the target company isn't always a perfect strategic fit. You just bought them because they were for sale.
So what does self-sourcing look like in practice then?
When a company self-sources 75% of its deals, It means they have an active, aggressive, highly specialized internal team that knows their specific industry geography intimately. They aren't waiting for a banker to call them.
They're out hunting.
Right. They are out there quietly identifying local, privately held companies that perfectly complement Granite's footprint. Like maybe it's a family-owned paving company that controls the only 2 asphalt plants in a county where Granite wants to expand.
Okay, yeah.
Granite's team approaches the owner directly, builds a relationship, and negotiates the deal privately, one-on-one.
It completely eliminates the auction premium.
Exactly. It leads to far better strategic fits, much more reasonable valuations because you aren't bidding against private equity, and ultimately much smoother cultural integrations when you merge the workforces. It is a sign of a very mature, disciplined, and healthy corporate growth strategy.
It is the difference between buying a house that a realtor is aggressively bidding up in a multi-offer bidding war versus finding a perfect off-market property because you intimately know the neighborhood, you noticed the house was looking a bit tired, and you knocked on the owner's door yourself to make a fair offer.
Yeah, it is just fundamentally smarter, higher margin business.
It is methodical growth versus reactive growth.
Exactly.
Wow. We have covered an immense amount of ground today.
We really have.
From a bird's eye view, this deep dive has been an incredible journey through the hidden mechanics of the world around us. We took a company that, on the surface, just pours concrete and paves highways, and we watched them engineer a massive cash flow turnaround scaling from $5 million to $142 million in a single year.
Incredible execution.
We untacked how they are brilliantly riding the coattails of the AI and data center boom, effectively turning Silicon Valley tech hype into tangible, highly lucrative civil engineering contracts. We decoded how they are strategically positioning themselves for the next wave of federal infrastructure spending by systematically favoring predictable, formula-based bridge repairs and progressive design-build models to insulate themselves from risk.
Right.
We explored how they literally hoard liquid asphalt to hedge against global oil markets and weather severe storms. And finally, we broke down the high-level financial gymnastics they executed to settle convertible debt, absorb hundreds of millions in non-cash accounting charges, and build an absolute fortress around their shareholders' equity value.
It really is a comprehensive masterclass in how a modern industrial giant operates at the chaotic intersection of public policy, private technology markets, severe physical weather, and complex Wall Street finance.
So as we wrap this up and digest all of these varied sources, what is the one big takeaway, the final provocative thought you want to leave our listeners with today?
If we pull all these threads together, I think there is a profound and fascinating irony at play in our modern economy.
Okay, what is it?
As our society becomes increasingly obsessed with the virtual world, with cloud computing, generative AI, virtual reality algorithms, and frictionless digital experiences, we are, ironically, becoming entirely more dependent, not less, on the most tangible, physically demanding, old-school, dirt-moving industries on Earth.
Wow. Yeah.
The digital cloud does not float in the sky. It lives on the ground. And you cannot host a next-generation AI model in the cloud without someone down on the ground, deep in the mud, fighting off severe weather in the southeast, to pour thousands of tons of concrete and lay miles of high-voltage cable for the foundation first. The limitless future of the digital world is entirely, inescapably reliant on the people moving the physical earth.
The cloud requires the mud. I love that. And it completely flips the script on how we view technological progress. The physical world still dictates the terms of the digital one.
It really does.
Thank you so much to our listeners for taking this incredibly deep journey with us today. The next time you are driving down the highway and you pass a massive construction crew, or you see a quarry churning out crushed rock and dust, I hope you look at them a little differently. They aren't just fixing potholes or causing traffic, they might just be laying the exact physical foundation for the next massive leap in artificial intelligence. Thanks for joining us on this deep dive, and we'll catch you next time.